All right. Joining me is David Dziekanski, CEO and Chief Investment Officer at Quantify Funds, who currently offers 5 ETFs overall, including 4 ETFs that cross over into the crypto sphere. That includes the stacked Bitcoin and Gold ETF, ticker symbol BTGD, which, as you can imagine, this has performed very well over the past year plus since it first launched. And then, along with that ETF, just last week, they launched 2 options-based income ETFs that also offer Bitcoin exposure. So these are in partnership with return stacked ETFs and Convexitas. So for example, there's the income stacked 1x Bitcoin and 1x Gold Premium ETF, ticker symbol ISBG. There's also one that has US stock exposure. And I should note that all 3 of these ETFs that I just mentioned are using something called return stacking, which I'm going to have David explain that for you. And then the other crypto ETF, which also just launched last week, is the Quantify 2x Alt Season Crypto ETF, ticker symbol QXAS, which provides leveraged market cap adjusted exposure to non-Bitcoin digital assets. So overall, you can see Quantify is building out a very interesting crypto-related ETF lineup. And so let me now welcome in the brains behind the operation. David, great having you back on the podcast.
Thanks, Nate. Such a pleasure to be back.
So out of curiosity, was the plan always for Quantify Funds to sort of lean into the crypto space, or was it something that sort of evolved as you started thinking about where you could differentiate in the ETF space? Like, how did crypto become such a big part of what you're doing right now?
Yeah, no, thanks. So we do coin it crypto hedged funds. I've been a big believer of crypto for the better part of a decade, both on the ability to have a store value, but also on the ability to have a technology layer. And when you look at where the rest of the growth is in the technological space, it's so concentrated in the Mag 7s. And everyone has massive exposure to those Mag 7 names. They're about 40% of the S&P 500. Even international investors are supremely overweight the S&P 500. So while we won't just be crypto focused, we are starting off in the crypto world. These 2 income stack filings or launches that we've had last week, ISSB and ISBG, are 2 out of 8 filings that we have in partnership with both Convexitas and Return Stacked. So you will see more broad exposures in this concept of return stacking, such as stocks and gold, treasuries and stocks, treasuries and Bitcoin, treasuries and gold. The idea is you should have equities, you should have treasuries, you should have Bitcoin, you should have gold exposure in your portfolio. This is a tax efficient, cost effective way to get a little bit of leverage that forces rebalancing between the 2 underlying legs. And really the only free lunch in market is diversification. But to harvest the value of diversification, you have to make the unemotional trade. And I think that's really the whole concept of return stack that Corey has really re-pioneered. Started with PIMCO Stock Plus in the mutual fund world in the 90s. Funny enough, PIMCO has now launched or filed for an ETF version of their PIMCO Stock Plus concept. So it's a way to get model level leverage and not have to worry about the daily disclosures of intended just for daily use. So obviously not 100% of the path dependency can be washed out of the ETF, but a big portion of it can, by doing a lot of that rebalancing embedded into the ETF, as opposed to putting the onus on the allocator to rebalance the leverage ETFs, and also doing it in a tax efficient fashion. So these income stacked ETFs, our beta is received, we get our beta from flex options on GLD, IBIT, SPY, so we can heartbeat these when we're doing rolls on our beta. So cost-effective form of financing at institutional rates, availability to redeploy. What is the point of having a hedge fund if when it either hedges or outperforms, you can't redeploy it? And then also tax efficiency of that leverage, making this just like things that you can't really recreate and compete with on your own. In its simplest form, I like to think of return stacking as addition without subtraction. Let's take gold, for example. Obviously, there's a lot of FOMO around gold. Gold, albeit outside of today, has done exceptionally well. There's a lot of people who are like, man, yeah, I know I need some gold in my portfolio, but like it's run up so much, like especially if you're a younger allocator and you're worried about, well, yes, gold might have a positive return stream going forward, but it might underperform the S&P 500. Well, if you have no form of leverage or return stacking in your portfolio, to add gold, you have to decide, do I want gold? And it has to outperform your benchmark, which for a young investor might be the S&P 500. With return stacking, we like to call it addition without subtraction, right? When you stack your gold on top of, in this example, your Bitcoin, its benchmark is no longer that equity benchmark for your whole portfolio, the S&P 500. Its benchmark is the cost of financing. As long as it outperforms the cost of financing, it's additive to your portfolio. So I think thinking about it in that lens of addition without subtraction is the best way to think about how return stacking can help you. We know the best institutions in the world find their optimal portfolio and put a little bit of leverage on it. And then the hardest thing is staying the course and actually doing those difficult rebalancing. So why not force that to be done embedded within the ETF?
Okay, so with the two options income ETFs you recently launched, again, there's the income stacked 1x Bitcoin and 1x gold premium ETF, as you mentioned, ticker symbol ISBG. And then there's the income stacked 1x US stocks and 1x Bitcoin premium ETF, ticker ISSB. I just want to make sure everybody understands the basics as to what's going on underneath the hood of these ETFs. So explain what somebody is getting here. What is the basic investment approach?
Yeah, first and foremost, in similarity to BTGD, you're getting a 1+1 exposure, which I think a lot of people might take for granted and assume that they're getting in the derivative income space, but oftentimes they're not. Some of the largest derivative income ETFs out there that focus on the S&P 500 and NASDAQ, et cetera, will oftentimes sell an option once a quarter and kind of just wait and see how it goes. We call that a little bit of a random walk. Because one day you might have a 0.8 beta, the next day you might have 0.6, the next day 0.2. So first and foremost, we're keeping aligned with the concept of return stacking. We can rebalance these ETFs up to 2 times a day. So we will do our best to get that target of 100% exposure of asset class A and 100% exposure of asset class B, which we think is a really the next evolution of the derivative income space. Not just, again, focusing on maximum distributions, but risk management over just pure strike selling. And that means you'll see us roll our options a lot more often. But we're getting our long exposure from an in-the-money call option, typically using flex options. So we can do the heartbeat trade and have tax efficiency there. And those could range anywhere from 3 months of tenor to 18 months of tenor. We'll sell cover calls against that position for a percentage of the notional. They could be at the money, out of the money, as short as 1 day or as long as 6 months. And so instead of having the potential alpha being generated from this random walk of like, well, your exposure just kind of like changed over time and that no one was really managing to that, we want our potential alpha to come from the types of options we're trading, the tenors we're trading, looking at the volatility curve, the skews of these underlying options, and deciding what is most appropriate, as opposed to just saying, zero DTE is the be all end all. Like, it's not. It works in certain markets, but it doesn't work in all markets. And so I think first and foremost, we'd love for the whole derivative income space to look at these things as tools and not be all end all panaceas that one way is better than everything else, because how you use them and how you put them together, just like a chef, is the most important thing. So we have our long call option, call it 20% out of the money. We have an embedded downside put on that. We have a short call option that can be as short as 1 day and as long as 6 months. And then for anywhere between 0 and 33% of the portfolio, we'll opportunistically sell 1 to 30-day puts on that as well. So the alpha, in theory, won't come from how much exposure we have to the underlying. We're always targeting a 1, but it's how we get that exposure in the ETF.
And I always like to explain things in very simple terms. So again, if we take the income stacked 1x Bitcoin and 1x gold premium ETF, essentially for every dollar that's invested, you're getting $1 exposure to Bitcoin and $1 exposure to gold. So $2 total exposure. And then what you're doing is you're selling calls on it and then also selling puts as well. Correct?
Potentially also selling puts, correct?
To generate income.
Yep. But most importantly, when you wrap all 3 of those legs together, we will have a 1 beta with all 3 of those legs together. Typically, if you just have the S&P 500 and you sell calls, your beta starts off at 0.67. So with all three legs combined, we will still have a 1 beta on each underlying asset class, which is why we look at these as risk managed tools as opposed to just strike selling derivative income strategies.
And so maybe this answers my next question. As you know, the derivative income space is one of the hottest areas in the ETF market right now, and that includes a number of crypto related products. There have been a lot of ETF filings here, a lot of ETF launches. I guess, what do you think is driving that? And my question is, I could make the case that the volatility of crypto can be a good thing, right? As long as an investor is properly sizing their position and they're engaging in disciplined rebalancing, I think that volatility can be a feature, not a bug. But clearly, some investors don't mind capping their upside, and they love this idea of income. So, talk about that, and what do you think is driving the interest here in the derivative income space, particularly as it relates to crypto exposure?
Yeah, and now before I go directly into like why the derivative income space has done so well, I'll say what's again unique about ours is that we won't necessarily cap that upside on a total return basis. We'll still have that 100% total exposure to the underlying leg. I think derivative incomes ETFs have been so popular. If you look at the structured product market, really what it's doing is porting over structured products over to the ETFs. And why are these of value, especially now? I think everyone feels like the world is a little bit unfair, right? Like, oh, what are you supposed to do for passive income as you're, hitting your 50s, 60s, heading towards retirement? Are you going to buy a real estate asset? Are you going to buy a business? Well, you're competing with the largest institutions in the world. And quite frankly, they just have much better costs of financing. So if they get that asset and pay 150 basis points less in their margin costs and the leverage costs, they have a lot more profit potential than you do. And it's just a broken equation where you're just not on the same playing field. So embedding institutional rates into these types of strategies puts you on the same playing field, even potentially benefits you more as these are done in a tax efficient manner. And then if you look at younger investors, a lot of young investors are worried about wage growth, right? They're worried about just meeting their current level of liabilities and costs, their car payments, their rent. So I think younger investors are using this to supplement their income to match the costs of living in today's very expensive world post-inflation. And I also think it's convincing some people to take some money off the sideline and get into the markets because they know at the very least are getting this return stream back. And I think a lot of finance will agree that younger investors tend to be underexposed to the equity markets or risk assets in general. Zed at Convexitas, our partner on this, often says, if you're young, you should think about the future earnings potential over the next 40 years as a bond. And when you think about it like that, oh my gosh, you are way too overexposed to fixed income in your portfolio. And so there's almost no amount of leverage that you can take when you're first starting off your career that is too much leverage. Because if you think of your 40-year income payments from working as a bond payment, you are already 80% exposed to fixed income. So just getting some of that leverage to invest today and letting it compound over time is really, really valuable. And that's where this concept of return stacking comes in. And then also, just as I alluded to, just being able to feel confident that like, okay, maybe I don't need 6 months of savings on the sideline. I feel more comfortable with 3 months of savings because I know there is this managed distribution that's coming back to me. And it is just that. It is a managed distribution. It is not pure income like a coupon on a bond. But again, doing the difficult rebalancing between A and B, harvesting the volatility premium, and paying a managed distribution, if done right, can really take out a lot of fears from getting exposed to markets. And some of the things that are going to differentiate how we do this is you'll see some of our competitors say, oh, there's been a lot of volatility in the space, we're going to overpay on the distribution right now. And that's so illogical to us. Why is there more volatility? Because the asset class has gone down. Obviously, there's more volatility in down markets. In theory, you're generating more premiums. And so you do have the ability to overpay during those moments, but we think that's a little bit backwards if you really want to create good shareholder experience over the long run. And so you'll see us not increase our payments on the drawdowns and wait for a reversal and kind of pocket some premiums and then pay it out as the asset class has gone a little bit higher. Because at the end of the day, we're focused first on total return and income second, but also just the experience of the investor holding this at NAV and not forcing them to come back in 2 years later and be like, well, if you wanted a good experience, you should have reinvested 100% of this back into it. I don't think that's the intention when people allocate to the space. They want to depend on that distribution stream.
With the income stacked ETFs, you had mentioned that your upside is not necessarily capped and you have this, one beta exposure. Can you just explain that in a little bit more detail? Because I think any investor who is in a premium income product, and let's say you're writing calls, again, they assume they're selling away some of their upside for income now. So I just want to make sure, again, that everybody understands how these income stacked products are working.
Of course. So if you have options that give you exposure to 100% of the S&P 500 returns, and then you sell calls on it, generally you start with a beta to the S&P 500 of 0.67. Right. And if that is not managed, that can change drastically. The next day it can be 0.8, the next day it can be 0.2. And oftentimes managers will not be targeting a specific beta. We think the next evolution of this space is to be risk managers first and derivative income distributions second, which means, we might get 130% long exposure on the S&P 500 through options and then sell calls on that and bring that down to a beta of 1. So it's doing it in a way that that like our potential source of alpha is not coming from this random walk of like how much exposure you have to the underlying asset, but it's coming to how we structure that exposure and keeping you confident that you will get that 100% exposure to each underlying assets with as many as 2 rebalancing periods a day, which is necessary, right? We launched last Wednesday, we seeded Tuesday, gold's been on a tear. We woke up Wednesday morning, we're like, well, we have a 0.85 beta to gold. We've got to kind of buy more gold. And you'd be surprised how much you actually have to buy in when you're constructing a portfolio in the options space to keep that targeted exposure at 100% plus 100%. So first and foremost, this is a very cost-effective way to get exposure to both of these underlying asset classes, whether it's stocks and Bitcoin or Bitcoin and gold for these first couple ETFs. And then we have more pairs between stocks, Bitcoin, gold, treasury bonds, and all combinations throughout. Then we also have 2 fun, what we call the MNAV harvester ETFs in that filing. And I think the concept here in general is, and I started off with crypto hedged funds. There's been a lot of innovations in the derivative income space, as you alluded to. People like doing this on crypto. There's a lot of volatility to be harvested. I think a lot of people received what they thought were received what they thought were portfolios that ended up being trading tools. Like, yes, you can generate that income, but like you have to decide when you want to go long that position or short that digital asset treasury company, et cetera. We have one ticker in ETF in that MNAV harvester lineup that's cheekily tickered YTSM. It's a Misty in reverse. But the idea is we'll pair Bitcoin with either, you can go short the digital asset treasury companies or long. We'll do that based on the relative value of them to their MNAV and trying to create full solution products so that you can be an allocator and not necessarily a trader. I think a lot of people got into the space thinking they might have wanted to be traders, and now have decided they want to actually be allocators and put the onus of those difficult emotional trades on the actual portfolio management team.
Let me ask you this. With the product proliferation in the derivative income ETF category, as you walk through everything here today, I think anybody listening will go, you know what, this sounds pretty complex. And I do think there's a lot of complexity in the space. The end result may not be complex, but just understanding what's going on underneath the hood can be complex. And when I think about all of the different products that are coming to market, I think there is some investor confusion out there, and there are a lot of differences in how some of these products work. So you'll hear about products where there's these astronomical yields being paid, but then you look at what's going on underneath the hood, what you see is a return of capital, and you have a NAV erosion and those sorts of things. So any tips that you might offer to investors as they look specifically at crypto-related income ETFs, but really we can talk about the broader category overall.
Yeah, first and foremost, don't invest based on Yahoo Finance returns. I think a lot of ETFs have been launched to gamify the Yahoo Finance chart with like a little bit of leverage embedded, where they're like, oh, if this asset class does well, we're going to look best over a 3-month period. Don't invest based on the distribution rate. You can only distribute what you generate. So for us, that's like the return of asset class A, the return of asset class B, the potential returns from diversification, and the potential returns from harvesting volatility between the two. I think looking at Sharpe ratios to compare similar funds, if you're looking at all the S&P 500 related cover call ETFs, yeah, it's not just returns. It's not just looking at Yahoo Finance. It's looking at the actual Sharpe ratios. And then I think most difficult is looking at the daily betas. Like, what is the daily exposure or relative exposure to the underlying asset class? And if it jumps around too much, you have to ask yourself, is that where the alpha is being generated from the manager, or is that just a random walk? And, if you're an issuer and you launch 50 products, one of them is going to have a good 3-month period, and I think there's a lot of people that just depend on that thesis right there to be like, yeah, but there'll always be something that looks good. And I'd like to say, I say, they'll do 90% of the revenue is a marketing budget and like 5 to 10% is actual construction of the product. Like, know who the actual portfolio managers are on it. That's why we were so excited to partner not just with Return Stacked and Corey Hofstein and Resolve and Phil, et cetera, but also with Convexitas that has true institutional experience doing this for 10, 20, $30 billion pension funds, where every bit really matters, and really getting that roll cost to be as little as possible, and really getting your targeted risk as close to your desired target as possible is the name of the game first and foremost. So I think, it was also really hard for investors to understand how an ETF that says it's going to distribute 100% won't give you all of your money back within a year, right? But it can only distribute what it generates from the returns of the underlying, the diversification, or harvesting volatility. And I think that's kind of been a little bit of the gamification in this space is, well, how am I as an individual investor supposed to look at this and assume I'm getting anything other than 100% of my total returns when it says 100% on the website distributions? And that's because it's not going to actually be able to generate that much in returns. So you're going to see a decline in the underlying assets. And I think also making sure your managers aren't capping 100% of the upside. Everyone talks about this, like no NAV erosion. Like, what is no NAV erosion in our opinion? It's don't overpay when premiums spike there's a drawdown on the underlying asset and volatility spikes. Why are you eroding NAV even further after it's already pulled back? And then does the underlying asset actually have the ability to participate on the upside? If you're just kind of a staircase down when an asset, you move in lockstep with it on the downside, and then you kind of get flatlined on the upside because you're selling 100% of the calls at the money, it might have these very juicy premiums, but then it looks a lot more like this ever declining bond profile than it is an actual way to get exposure to that underlying asset class.
So do you think it just comes down to more education is needed in this space? It's funny because you'll see these, quote unquote, financial influencers out there that are, prominent around these income-based ETFs. I don't know how good of a job you think they're doing, or if they're not doing a good job at all, but talk a little bit just about the education in this space.
Actually, I think they do not get enough credit at how fast their adoption knowledge curve has grown. When they first entered in this space and they first saw these nosebleed yields, they didn't know how to analyze these ETFs. But I think their interest in doing true deep dives and doing these 45, 60-minute videos with portfolio managers and really understanding it, and also the hive mentality, they're not in a bubble on their own. They all know each other. They all know this is the person who really understands derivative income strategies. So they wait for that person to give their blessing on a new concept or strategy before they'll start having them on their shows. Yes, I think a lot of them got burned, just like pumping some very high distribution ETFs to start. But I'm actually so proud of the knowledge adoption that they've had collectively, almost in a beehive. If you're a financial advisor and you have a source of alpha, you keep that to yourself, right? If you're a financial creator or influencer, you share it amongst the group. So one, the ability to really care to do multiple 60-minute deep dive reviews a week. We all know the best financial advisors need to spend most of their time gathering assets, and they don't necessarily have all the time in the world to devote like 6 hours a week to doing six different 1-hour reviews with different portfolio managers. That's not a good way for them to grow their business, and the hive mentality amongst the financial creator space. So I think you're seeing a lot of these financial creators be a lot more selective with who they decide to bring on their shows, because they have been burned. And some of them, this is their entire livelihood. And, if they were the XYZ firm derivative income guy on YouTube, and that's fallen out of favor. And all they did was push that one thing. Their livelihood is from that line of business is now over. So I think they're a lot more cautious on who they actually allow on their show and who they partner with. And so I'm actually endlessly impressed with. I feel like they've gotten a PhD in derivative income strategies in the last 2 years. So yes, 2 years ago they weren't as knowledgeable as they probably candidly should have been, but now I think we're in a different totally ballpark.
All right, let's talk about the other two crypto-related ETFs that Quantify offers. We mentioned the stacked Bitcoin and gold ETF, ticker symbol BTGD. I think, why don't you compare that to the income stacked Bitcoin and gold ETF? So if I'm an investor looking at both of these, what is the difference between the two?
Yeah, so our first ETF, BTGD, similar concept, gives you 200% exposure, Bitcoin and gold. It forces you to harvest the benefits of diversification between the two, forcing you to do those very difficult rebalancing periods within. I was just on a Spaces, just literally as I was leaving that to come here. I was like, these gold bugs that are doing so well over the last 5 years, they were gold bugs in the 2010. Most of these people now that are making money now were sitting on gold in 2013, 2014, 2015, waiting for this moment to come. And they did not feel as successful in their thesis then as they do now. So the non-derivative income stacked lineup that we have with BTGD allows you to focus on maximum capital appreciation, whereas the derivative income space allows you to focus more on these managed distributions, where you might need to depend on actual distributions that you're receiving from these funds. And also with the cherry on top of also harvesting a little bit of volatility premium from the underlying asset. So if you see ISBG and BTGD and you chart the two, they have performed pretty similarly between the two over the last 8 days that they've both been live. But it's just pick your poison. Do you want managed distributions? Do you want that derivative income space, which we will be a weekly paying ETF? Or do you want pure capital efficiency and growth?
Okay, so very well said. And then the other ETF, which you just launched, is the Quantify 2x Alt Season Crypto ETF, ticker symbol QXAS. Very interesting. Tell us more about this one.
Yeah, it's a lot less degen than it sounds. You're seeing a lot of ETF firms file for indexed baskets in the crypto space. And I think really what we're trying to do with this lineup, this is one of 3 filings, is to offer that index concept in the leverage ETF space. So alt season just really means excluding Bitcoin. We do have an alt season that excludes Bitcoin and Ethereum in that filing as well. But the idea here is to get access to the largest mid-cap and large-cap cryptocurrencies without necessarily choosing one winner. I often find so many people are like, well, but what's the one crypto that I'm going to make 10,000x on and become rich on? And it's like, listen, if you believe in this category, worry about beta before alpha. So this is a good trading tool to give access to right now, a basket that's Ethereum, Ripple, and Solana. You'll see us add up to the top 10 cryptos as they become available in the ETF wrapper and futures markets, etc. But this is not meant to be, Melania coin and Dogecoin and just cryptos without actual benefits. And these are true technology platforms. And to go back to the first conversation we had here, is why cryptos? Because, people already have massive exposure to technology in the equity markets, but they're so underexposed to technology in the crypto space or store value in the crypto space. We think the concept of a 4-year cycle is a thing of the past, and I can go into greater detail as to why. But also the greatest innovation in technology is happening on these layer 1 cryptocurrencies that, you see the New York Stock Exchange talking about moving everything to blockchain. You hear BlackRock talking about the same thing. Every asset is going to eventually be tokenized. And as we've seen this week, our administration doesn't actually care about long-term value of the dollar. So you have to find scarcity assets. So cryptocurrencies offer both unique stores of value and unique technology platforms that are under-owned in this marketplace.
You mentioned this as a trading tool. This is a daily reset ETF, yep. Is that correct? Can you just talk a little bit about the implications of that? And somebody may see this and go, I want 2 times leverage exposure to this basket of non-Bitcoin digital assets. That all sounds great. They may buy it day one and hold it for a year. And then at the end of that year, may be a little bit surprised at what their performance looks like versus a non-leverage index. Can you just talk a little bit about that? I think that's an important point for people to understand.
Yeah, like any leverage ETF that's not return stacked, the onus is on you to do those rebalances. You can get 2x returns if you allocate to the 2x S&P 500 ETF. You just have to trim when it's doing well and buy when it's doing poorly. It's not a natural form of portfolio leverage. So the onus is on the allocator to do those difficult rebalancing periods to get to your intended leverage target. And similar with QXAS, this is not deemed return stacked. There is diversification. We do have caps. We cap 50% of the basket in the top name, which currently is Ethereum. And we cap 75% of the basket in the top two names, which is Ethereum and Solana. So there is some rebalancing being done in here, but you do have to look at these exposures in your portfolio at the end of the day and decide, do I need to true up on this position or do I need to trim it a little bit to get a longer term 2x target on the basket? So this definitely fits more in the traditional leverage ETF space, whereas the income stacked and stacked lineups are a different evolution of leverage ETFs that can be bought and held, where almost all of that rebalancing can be done within the ETF. And we remove a lot, if not all, of the path dependency. So there is some path dependency in QXAS. But again, as long as you're willing to do some of those trades, which I know can be emotional, this is an amazing tool to round out your Bitcoin position. I think when we filed for this, Eric Balchunas said, this is kind of like, he said our Alt Season ETF was kind of like MSCI World XUS. It's like, and that's the exact concept, is trading tools that like give you the other. I think the 40X space has lots of allocations to Bitcoin, but they're underexposed to everything else. And so this is a very simple tool to get exposure to that other, besides for just Bitcoin.
All right, just a few minutes left here. You'd mentioned the 4-year cycle. Any thoughts on the crypto markets overall right now? It's been a challenging last 6 months or so in the space, I would say overall, if you look at performance. What are you seeing as you look at the crypto sphere right now?
I think the underperformance in crypto over the last couple months comes down to, in my opinion, three main things. One, people who are tied to this concept of the 4-year cycle. We are not believers that the 4-year cycle is a thing anymore for two reasons. One, the type of allocators that are picking up crypto exposure now are the institutional world, where they might have, I think Bank of America issued a guidance of like 0 to 4% in crypto. All right. So if you have 1, 2, 3, 4% in crypto and crypto falls 20%, you're not going to be a forced seller. You're not going to, have a margin call because crypto went down 20%. If anything, you're going to be more likely to want to increase that exposure. Two, the 4-year cycle, in our opinion, oftentimes had a bump in price because of the cut in supply during the halving. But this past halving, we went from 1.72% supply to 0.86%. We only cut supply by 86 basis points. That wasn't actually a meaningful cut in supply, in our opinion, that would cause any sort of rally. And so part of the 4-year cycle is that the halving would cause so much drop in supply that the asset would just run up. And yes, when we went from 15% Bitcoin supply to 7.5% Bitcoin supply, yes, that is a significant, substantial cut in supply that's what will cause supply and demand dynamics to be off tilt. And then what do we go through? Oh, also, obviously correlation to technology stocks. But I think most importantly, if you look at the Japanese 10-year bonds for the last 6-7 months, the yields have trended from 1.6 to almost 3, back down a little bit, but they are rising again today. I think everyone knows that the yen carry trade is the ultimate form of leverage financing in this world, and so with rates increasing there, I think it's really hurt risk assets such as cryptocurrencies. But we saw for the first time since the great currency crisis in the 90s that the U.S. the Federal Reserve is actually going to step in and buy yen and try to support their currency. So for the first time since the 90s, not only is Japan doing something about their bond market and their drop in currency, so is the U.S. as well. And, the president basically alluded to earlier this week that he doesn't really care about the value of the dollar. So if you don't care about the value of dollar, you want to support the yen, these scarcity assets will ultimately have some value. And you go back to the concept before of, a lot of these gold bugs who are proven right today were sitting for 6 years in the 2010s on their gold allocations, scratching their heads, having clients yell at them for an underperforming asset class. that they ultimately were validated for having over the long run. Gold has outperformed the S&P 500 over the last 15 years. And I think it's very similar to crypto. I think 6 months is a blip on the radar of time. So the halving cycle being a thing of the past, the 4-year cycle being a thing of the past, but people still traded the 4-year cycle where there was like, oh, now crypto's supposed to go down, right? So, and then the yen, 10-year treasuries in Japan, interest rates were going up. I think this all coincided with a very difficult period for cryptocurrencies.
So are there any key drivers you're watching then moving forward? You mentioned the weaker dollar. And if you want, we can separate, I don't know if you feel this way, we can separate Bitcoin from other crypto assets.
Yep.
I've said before, right, Bitcoin has characteristics more along the lines of gold. I know some people will debate that if you look historically, whereas other crypto assets may look much more like technology stocks. But like, how are you thinking about this moving forward? What could be some key drivers for the space, key positive drivers?
I think both the store value concept and also the technology layer concept is still beholden to cost of leverage in this world. So first and foremost, will Japan kind of cap this endless climb in their 10-year yields, which quite frankly, they just have to. I think I saw a stat that they own 50% of their own bonds. Like, they'll just go to 55%, right? Instead of letting the whole system implode, they will just buy more. Now the US is also buying their currency. So I think focusing on that, on the store of value concepts like Bitcoin makes a lot of sense. And then the technology platform, it's just a matter of time. Like think about, NVIDIA in November 2022, right? If I told you JP Morgan has a stable coin and BlackRock and NASDAQ are talking about tokenizing all stocks on public markets, it's like, well, how do you make money off that? It's like, well, the cryptocurrency layer one platforms, right? Like, it might not feel like it today, but as these technologies get put into more use, the prices just have to go directionally upwards. So again, I think 6 months in the blip of history is so small. You just have to take a step back and look at the forest through the trees and decide, like, has your thesis really changed? And I think for a lot of bulls in the space, it hasn't. It's just been a bad price return experience over a 6-month period.
Well, David, again, so great to connect. I always appreciate your views on both the ETF market and certainly crypto. And I wish you all the success as you continue building out the Quantify ETF lineup. Thank you for joining me.
It's an honor to be on here. I always love connecting with a fellow follically challenged brother. So, but I appreciate you and I love your show. And thank you for spreading the good word and giving really good information to people to get better informed in this space, because there's 4,600 ETFs and that number is not slowing down. So we need more voices like yours to really disseminate. Like, you can't say a manager is definitely going to have alpha or not, but you can kind of garner if a manager is striving for alpha or not, I think. And you do a great job of differentiating that. So thank you.
Well, thank you. I appreciate the kind words. And again, greatly appreciate you joining me this week. That was David Dziekanski, CEO and Chief Investment Officer of Quantify Funds. Hope you enjoyed this episode of Crypto Prime. As always, you can stay up to date on all of my latest guests by visiting CryptoPrimePodcast.com. Thank you for joining me.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. Some guests appearing on this program may also be financial sponsors of Crypto Prime. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit CryptoPrimePodcast.com for more information.